This is the reason why you still don't understand the draw on liquidity. So in the previous video, we touched on internal range and external range liquidity, but how do we decide which one the market should gravitate towards? So in today's video, we'll be going over how to find your draw on liquidity, whether that's internal range or external range, and how you can piece that together to aid your bias. So in order to determine our direction for order flow, we need to understand three key concepts. Number one, manipulation. Number two, fair value gaps. And number three, speed. So here we are on the charts and we're going to piece together these three steps, right? So looking to the left, we can see that we have ran this major buy side liquidity pool, right? This old high to the left, which was actually an intermediate term high, since it rebalanced this fair value gap, we've run up higher, ran the buy side liquidity pool resting above the high and immediately displaced lower. So here we have our manipulation. What else do we have? If we look more to the left, we can see that price has traded into this bearish breaker block, right? So we've run up higher, taking out buy side liquidity, and then tapped into a bearish breaker block. Following this, we have displaced lower, creating a fair value gap, right? So what do we have so far? Number one, manipulation. Number two, fair value gaps. Now, I want you guys to really think about this. Why have I emphasized fair value gaps? So the reason being is when price is displacing bearish in a bearish market, we want to see fair value gaps being created. So if I'm seeing manipulation to the upside and fair value gaps being created to the downside, that is the first sign that price should be moving bearish. Now, once I've understood this, the next thing that I really want to focus on is the speed of price. So as you can see, coming up to this buy side liquidity pool, we can just measure this out, right? So from this initial push to get to this buy side liquidity pool, it took us six candles, right? Or 8 days including the weekend. So it took us 6 candles to get up to the buy side liquidity pool. But then how quick did it take us to get to the sell side liquidity pool here, right? You see, this is a 3-bar swing pattern low. It's a form of sell side liquidity. So we want to see how quick price is moving to buy side liquidity and how quick price is moving to sell side liquidity, right? We can see that once we ran this buy side liquidity, the next candle immediately ran to the sell side, right? So there we have 3 of our factors now. We have the manipulation, we have fair value gaps being created to the downside, and we have speed and willingness to run to sell side liquidity. So once again, the reason why I emphasize on speed is because once you understand where the market is urging to go to, keyword urging, where it is displacing very fast towards the buy side or the sell side, once you understand that, all you have to do is simply identify, are we rebalancing internal range or are we going for external range liquidity? Now then, here we are on the same chart, but this time on the hourly time frame, right? What can we see? Relatively equal highs being manipulated, price trading above and then moving lower. Once again, we have an old high being traded above, buy side liquidity manipulation, and then we're displacing lower with fair value gaps and speed, right? You can see how quick these candles are forming relative to these up candles. Once again, we have an old high being liquidated, price trades above the old high, and look how quick we displace lower in comparison to this slow bullish push up. Right, compare the momentum of these candles to these candles, and then we also have the fair value gaps being left behind. Once again, manipulation, fair value gaps, and speed. Right, now you may argue we are having fair value gaps being left to the upside, but we don't have the other factors, right? Sell side liquidity is not being manipulated in this whole run higher, whereas buy side liquidity is being manipulated on these runs lower. We also don't have speed on the way up. You can see these candles have very low volume and are really choppy on the way up. However, on the way down, you can see we're getting these large bearish pushes, leaving behind fair value gaps. So it's all about piecing the three concepts together. So if you do not already have a good and clear understanding of internal and external range liquidity, please watch our previous video on this, as it will help you massively. Okay, great. Now that we understand which side of the market price is moving towards, we need to find our objective. Now there are two types of objectives, either internal range liquidity or external range liquidity. And the confluence we are going to be looking for is low resistance liquidity, right? Low resistance liquidity is an area in which price should slice through with ease, right? There shouldn't be any issues getting towards this area, and this is usually, in the form of a swing failure pattern. However, FVGs are also a form of low resistance liquidity. The reason why FPGs are a form of low resistance liquidity is because they are usually very easy targets to go for, right? Price usually delivers to inefficiencies with ease. Okay, so here we are back on this hourly chart, right? I have played this out a bit since, price was moving very quick and didn't offer much retracements for entries. So we're going to study, this leg of price action and see what's happening. So if you mark out our premium and discount from range low to range high, here we have, anything above the 50% is a premium, anything below is a discount. So if we're looking for sales, we want to sell in the premium, and, vice versa. If we're looking for buys, we want to buy in a discount, right? So, I would like price to trade up into the 50% at the minimum, ideally into this sort of tiny fair value gap, potentially into the order block, but our main focus is this fair value gap. So I will play price out until we get there, right? Here we are at the 0.60 level, optimal trade entry. We've just wicked the 70.5 as well into the order block. So coming back onto this hourly chart and looking closer, what we have is swing failures, right? You can see these lows are failing to take each other out, right? This low did not take out this low. This low did not take out this low. This is a form of engineered sell side liquidity, right? That is one confluence I told you guys to look out for. So we need to decide internal range or external range, and then do we have a swing failure pattern. So in this case, we're coming from internal range and we're going towards external range, right? This range low. I can now delete this to make this clearer. So we're going for this range low. Let's put that in blue. Here we are. This range low, right? The external range liquidity, and we have swing failures as a confluence that price should slice through this level. So now let's go into the 15-minute chart to get a bit more clarity, right? So marking the optimal trade entry on again, you can see, let's play this out a bit. Price has actually come into this level here at the 79%, right? The actual optimal trade entry, the most extreme form of the OTE. Anything higher than the 79 level is no longer an optimal trade entry. It is still a premium and still valid to look for shorts, but the 79 level has extra confluence, right? And as you can see, here we have these swing failures. So we're going from internal range liquidity to external range liquidity, right? Let's just clean this up a little bit and then we'll play this out. This is our draw on liquidity now. So we've used the three previous factors to understand we're in a bearish market on the hourly and on the daily. And now we're looking to find our draw on liquidity with our simple factors, right? Are we going for internal range or external range? And do we have any swing failure patterns? Yes, we do. So let's play this out. And as you can see, we get through this level with ease, We only had one retracement candle through this whole move. Price impulsed straight through these lows with little to no resistance. We didn't struggle to get beneath these lows. We didn't even get a pullback. There was no sort of pullback, right? Price just paced straight through these lows, making this a very high probability draw on liquidity. So that's the first example, and I'll show you guys another. So going back to the hourly chart, let's play this out a bit and see if we can get involved in this leg of price, right? Let's just clear this up. Okay. So, okay, looks like we already had, a very quick return into internal straight to external here. So we'll disregard that and we'll draw our new price range. Okay, here we are. As you can see, price has retraced into the premium of this 1 hour leg. But coming onto the 15-minute, you can see this is actually a fair value gap, right? Again, we have the signatures. We have buy side liquidity being raided, speed to the downside, and fair value gaps being created. So I'm now going to remove this and let's draw out our fair value gap. As you can see, we have traded into this fair value gap and we are creating swing failures, right? You can see these these lows are failing to take each other out. This is a major confluence. So if we play a price out now, you can see we had a run on buy side liquidity again, accumulation, manipulation, and then we have speed to the downside with fair value gaps being created. We understand that we are inside internal range liquidity, so the next draw on liquidity is external range liquidity, this low here. So playing this out, as you can see, price slices through this low with ease. The reason why it does it so easily is because this is all low resistance liquidity. These lows failing to take each other out signifies their weakness, right? It really shows us that the market is in a very weak bullish trend short term to get into this internal range liquidity, right? Essentially, this can be viewed as trendline liquidity. Retail buyers are buying at each tap of this trend line, right? This is one massive trend line like this if we refine it. So essentially, when price does trade into the internal range, we should nuke this level with ease. So that pretty much wraps up the video. I hope it does help. If there's anything else that you guys would like to know, please let us know down in the comments below. If there's anything that wasn't too clear, please let me know. I will also clarify that for you guys in the comments, and I will catch you guys in the next video.